So here comes the eternal question. What should you do with your losers? Should you wait? Should you buy more? Or should you sell? Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I am with my co-host Véronique and a voice that is having a bit of a problem, but I'm confident we're going to be able to go through the entire podcast without me losing my voice completely. How are you doing, Vero? I hope that you're doing better than me.
I'm doing good, except that I just lost a hen.
Yeah.
So her name was Chipit, so R.I.P. to Chipit. She got eaten alive, poor little thing. But Mike, what's happening on the soccer field?
Well, that explains my voice, actually. For people that don't know, I coach a soccer team. They're like 13 years old, and we're playing a fairly good level, but the kids are not having a great season right now. I'm not having a great season. So we have definitely a lot more losses than wins. And it's hard at that age to convince teenagers that there is a process behind that. And the result doesn't necessarily mean something. And they have to focus on that process. And yeah, so I try to be involved with them, and hence my voice, because we just came back from a tournament that didn't go well, and after that a game that didn't go well. So trying to keep them up and follow that process. And actually it's kind of like a good segue with what we're going to talk about today is sometimes we have losers in our portfolio that are down 20, 30, 40%. And it's not necessarily a moment where you should establish a trigger just to sell and quit. The short-term results is not exactly what matters. What matters is your process, your investment process. So as much as I'm trying to teach those kids to focus on that process to become better players and become better as a team, well, today we're going to look at the process of how should you look at your losers and what are the frameworks that can help you determine if you should buy more, if you should sell, or if you just put it in a box, forget about it for a few months and then come back later.
Yeah, because just like you've said, the overall market is not performing too badly this year, but some stocks are taking a beating, and investors always wonder what should I do? Should I let them go buy more? And yes, by the way, listeners, UnitedHealth, UNH, is in the list today, so we'll take a review on that one for sure.
How can we ignore this one? I don't hold any shares of this one, but wow, one of the biggest holding in the S&P 500, one of the biggest company by market cap, been there for so many years and down more than 40% this year. There's a lot of things to talk about. I just want to take a quick minute to mention this note though. A lot of investors right now, they look at their portfolio, and if they're in red, they will blame Trump economics, or they will blame Liberation Day and the tariffs war and all of that stuff.
Right.
But if you really look closely, after the first 6 months in the market, both the S&P 500 and the TSX 60 are in positive territories. So that is not a valid excuse. And I'm sorry to break it down to you, and I'm sorry to be blunt, but right now, if your portfolio is down, you need to find another reason why it's not working, because Trump is not destroying the stock market. Whether you like him or not, doesn't really matter. And I've been saying that for a while. Politicians, they do politics, they don't do stock markets. So yes, they have short-term influence, but that short-term influence of Liberation Day, I think it lasted 3 weeks. So, and then people were talking, oh, it's a market crash. And I'm like, wow, market crash at last 3 weeks? We're far from 2008 now, guys. You have to get your definition in order and establish clear rules. When you say market crash, it should at least be 30-40%. It should hurt like there's no tomorrow, and it should be opening to a bleak future and not much hope for the next 2 years. That is a crash. The stock market going down 10% and then going back up within the next 2-3 weeks, that's nothing. So today, instead of talking about emotion or talking about fake stories that we tell ourselves, we're going to actually focus on a framework to make decisions better with your losers.
Right. So let's start with one of the most famous names in the information technology sector, Apple. Its price is down by about 20% since the beginning of the year. So what's happening, Mike?
Yeah, seriously. I mean, we have to start with one of like my biggest holding, actually, my largest holdings, Apple, down 20%. What a bummer. Definitely not a good year. I mean, Apple is kind of like victim of like a very bad narrative over a lot of different topics. The first one, of course, the commercial war that is there, and I just told you it has no impact. Well, in this case, they're highly vulnerable because they're literally stuck between China and the US. So a lot of
Mhm.
investors are just like, yeah, what's gonna happen with the iPhone? Trump wants to have the iPhone being manufactured in the US. Apple says we're gonna have to sell them at like $3,000 or more, so it's not viable. Anyway, there's like that back and forth and a lot of tension over that story. But it's not the only thing. If it was the only thing, actually, that would have been just like a smooth walk in the park, just some fluctuation. Probably that Apple would not have generated that much return year to date, but would have not been down 20%. The problem is, it's been a few years now that Apple is not generating that much growth. Not like the usual Apple growth, like high single to double digit growth type of thing. So people are waiting for the next innovation. And usually when you look at Apple's over like its past history, it goes through those product innovation cycles. So
Mhm.
they launch a new product, a revolutionary version of the iPhone, boost sales, everything is rolling. They're generating even more cash flow. Then it slows down for a few years. They work on something else and then they bump back again. While right now, investors have been quite disappointed with AI expansion. So, I mean, artificial intelligence has been the buzzword for the past 2 3 years, even stronger now when you look at all the technology companies. I mean, it's just if you don't have like a very good AI product or service in the work or actually doing something right now, people just ignores you. And this is exactly what's happening with Apple right now. They're having difficulties integrating like efficient AI into their smartphone. Seems kind of like an obvious choice on top of that. But and then they had their product day not too long ago, and they did not make major announcement of like about any AI integration or features that would be coming
Yeah.
up. So when you mix the overall negative narrative around the commercial war plus the fact that there is like problems, literally problems within the company, it makes it a lot harder for investor to get excited. Plus you have other companies, as I said, if the market is up right now, well, that means that there are a lot of companies are doing well. So you might as well just like ignore Apple and focus on another stock and then just be, hey, that's the new flavor of the week. I'm making money with this. And then Apple is just dead money.
Now, what do you think investors should expect? Like, should they sell some? Should they buy more? What should they do?
Well, I don't think Apple is dead yet. I hope not because it's the largest holding that I have. So obviously, probably a bit biased here. But I mean, there are a lot of like fundamental key points, fundamental strengths that Apple still has. It still have an iconic brand driving a lot of raving fans. They generate tons of cash flow. They have this ability to use this cash flow to either invest more in R&D to come up with an innovation or to make acquisition as well. So they have a lot of resources and a great history of success to bring
Mhm.
more great products and services on the table and make money out of that. So while I was also part of those investors disappointed by the lack of AI innovation, I'm willing to be patient a little bit more to see what's going to come up next. Of course, I'm going to follow this one closely for the next quarters to see if there are like any signs of improvement. It wasn't going that bad as of late, but now we're just thinking, well, there's probably some doors being open to a lot more growth and they're not taking it. I mean, if I compare this to Microsoft, where they're just reporting like double digit growth pretty much everywhere all the time these days, it is certainly disappointing. One thing I
Mhm.
want to highlight here is when you have a company, and when you look at the past like 3 and 5 years of Apple, the return has been very, very strong. So on one side, yes, it's a bad year, but now you're just focusing on 6 months. I mean, you should
Right.
focus on a lot more. And of course, if you bought Apple and your first position was in January of 25, you're not happy with your investment right now. But again, you need a little bit more time for that. There are probably reasons why you bought it. Well, they're probably still valid. I mean, it's not because the stock market decided otherwise that you made a bad investment for this short term. For my case, I've been holding Apple in my portfolio for more than 10 years now, and I've been trimming at least 3 times now my position. So the point here is always to balance out your risk and reduce that exposure to one single company, no matter how great it is, to maybe
Mhm.
determine like what's the limit in my portfolio. And I like to put the limit in percentage so I don't have to think in dollars. Because sometimes you're thinking dollars and you're just like, oh my God, it's like $10,000, $50,000. That's a huge amount of money. But when you put that into percentages, you're just like, oh, it's not that bad. So I've set the limit to 10% in my portfolio. And that's totally arbitrary. Like your limit could be 6, and that would be totally fine. The point is to have a line that you draw in the sand, and then whenever you cross that line, you just sell some shares. So I kind of regret because I was really close to that 10% in December. So I did not touch my shares, and I should have trimmed for the fourth time, knowing the future. But I mean, it's always easy to play Monday morning quarterback. I'm not disappointed right
Right.
now. And I think that Apple has a lot of things going on and a lot of resources to bounce back. So I'm definitely willing to wait a little bit more on this one.
Another well known brand is Target, TGT, which is down by more than 25% since January. What could explain this?
So I often say that when you have a stock that goes down or goes up, it's driven by numbers, right? So numbers will tell a stronger story than the overall narrative that, oh, everybody is shopping at Target. And here's the problem: barely no revenue growth, weaker earnings per share, slower dividend increase over the past few years, not even 2% in 2025. So you can see that when you look at the dividend triangle, it's not looking that great. Now we have potential for recession going forward. Of course, tariff is still looming around, but you see that that's just like the tariff war, and politics is just another layer on top of what's really happening right now. So if
Mhm.
Target would have shown like 5% revenue growth and 4% EPS growth, and then strong comparable sales increase, and the dividend would have increased between like 5-6% per year over the past 2 years, probably that people would be still, oh yeah, there's a potential of a risk here for a recession and the tariffs, but Target is still a pretty good investment. But this is not what's happening. I mean, the latest quarter wasn't good either. We had like comparable sales dropping by 4%. So that was a lot worse than anticipated. If there's something worse than having bad numbers in your quarterly earnings, is having bad numbers when analysts expected like something else. And then when you cause that surprise, well, of course, analysts, they price Target based on their assumptions. And now the company's telling, well, sorry guys, your assumptions were wrong. Actually, you were quite optimistic and we're not
Mhm.
there. Not at all. And that explained why the stock price is down. So it's just purely driven by numbers. And then you have a layer of bad narrative on top of that. So you got the perfect combination of like disappointment, bad numbers, and bad narrative, bringing Target down 20-25%.
Now, Mike, you've never been like a huge fan of Target, so should investors just sell it and move on?
Yeah, I'm probably not the best person to ask that because I never got the hype about Target. Like when it was like going up, like in 2021, I was like, all right, it's an interesting store. The business model is good. I had like nothing against it, but just thinking about, well, I could buy Target or I could buy Walmart, or even better, I could buy Costco. So why in the world would I go back to buy Target again? Not too sure. So right now it's one of those companies that went high very fast during 2021, 22 following COVID. Kind of like the hype has faded big time. Everybody's going back
Mhm.
to earth. So I don't have any conviction in this kind of stock. So that's probably why I would sell. I'm not, again, not the right person to ask because I was not convinced about Target as a great investment for my portfolio prior to 2020. Then again, today, I'm still not convinced. So I look at those numbers and I'm like, you need to go back to your investment thesis to see what you really loved about that company and if it's still valid today. With the numbers that I've seen from the dividend triangle, it's really hard for me to be convinced that there's something better like waiting for Target. I'm not saying that it's not going to recover for some part, but I'm yeah, I don't see, I see like other investments in this same sector a lot more attractive, like Costco. Or, I mean, back then, back in 2016, 2017, I did the analysis of Target versus Walmart versus Amazon to see which company would do better with e-commerce. I ended up picking Amazon, which is one of my rare non-dividend paying stock, based on that
Mhm.
analysis, because I thought Walmart is going to be a very strong number two. Target, definitely not convinced, but Amazon definitely has all the cards in their hands. And I mean, it played out very well. I'm super happy to have Amazon, because on top of that, they opened with cloud services, and now they keep on growing on that though. But Target, like, was really at the bottom of that analysis in any ways. So that's why I was not excited back then. Still not excited today. Sorry, guys.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. All right, so let's now hit the elephant in the room, United Health Group. This one is down by more than 40%. And so much has happened that investors are just lost. So, how would you summarize all this, Mike?
Yeah, like for the first two, we're talking about like some numbers and some like layers of narratives. United Health Group kind of like piled up a record number of layers of bad news in the past 12 months. I rarely seen that actually. So in 2024, we have to go back like maybe like 12 to 18 months before. In 2024, they had a major cyber attack that created like their entire system. And I mean, they're providing like prescriptions and drugs and services, healthcare services. So, I mean, it's a very big deal. Completely frozen their system. It cost a bunch of millions, plus, of course, reputation that is being attacked there. So that was already a first dent in their armor. Then we had the CEO of the insurance murdered in December. So again, nothing related to the performance of the stock, but definitely not good news. I mean, it's not building a great narrative or anything else. And then we have lawsuits. And then we have the Department of Justice, DOJ, going after like antitrust investigation, fraud investigation. And then we add like the first quarters of 2025 that were very bad because they did not manage Medicare costs properly. So that hurts their earnings. And keep in mind, this is the type of business that used investors to get like double digit earnings per share growth pretty much every single year for like a decade, if it's not more. So you're used to see this thriving, super strong, super stable company, and then boom, nothing works. Margins are getting squeezed. They suspended their guidance. They're under investigation. The CEO steps down, which was a surprise on top of that. I mean, how many layers of bad news can you add to this story? That's just kind of crazy. And when you look at the numbers, so far, they're not that bad. I mean, yes, they were not as great as expected, but it's not like the company's losing money right now. But still, like you have like too many bad news piling up on all different types. I mean, the cyber attack, the lawsuits, the murder. I mean, nothing is like related. It's just okay. So I'm going to try to get hit like on all sides of my business at the same time and see if I can survive. So if there's a glimpse of hope, management, of course, management is not going to tell you that they're going to go down and they're going to lose money, but they said that they maintain their expectation for an double digit earnings per share growth target after this stuff here. So starting in 2026. But still, I mean, that's like a small glimpse of hope. And it's really hope at this point. I mean, you have to trust new management. They brought back an old CEO that made UNH great like about 10 years ago. So there is still some good things happening, but wow, that was quite a ride at this time.
But then is this like a buying opportunity or just a bad stock to hold?
I'm actually fully invested right now, but I'm still tempted to make some room to add UNH. I see this one. Of course, it's not like a super strong play. As I just mentioned Costco not too long ago, where like it shows like a perfect dividend triangle and like a great story. Like nothing is happening bad around Costco these days. But for United Health, when I look at the dividend triangle, it's not catastrophic. I mean, still growing, still moving forward. The I don't know, like the opportunity is still there. I think there is a lot of things that could happen in 2026 if they can bring back like their margin under control that Medicare cost, and then go back to double digit growth. I think they will come back on a strong recovery, but it's definitely not like 100% sure shot here. But I would be tempted to add it to my portfolio.
All right, now, spoiler alert, all the other companies we will discuss today are in the industrial sector. So, before we continue, like, is there any context around this sector that creates so much tension, Mike?
It's kind of funny because when we prepare those episodes and it's we talk about stocks, I usually like pick most of them and then I send it to Veronique. She does the research and then she like create the podcast. And I even noticed that it was all about the sector, like this sector. Like I was like, what? Ironically, I think it's just a coincidence. It's a coincidence in the sense that like the upcoming stocks that we're going to talk about, I mean, we're talking about like transportation, construction products, and even human resources services. So nothing really linked together. So I'm not sure there is a like obvious driver, but definitely a lot of companies. I mean, when you think about that on one side though, if there is like one point in common, I just thought of that. Most industrial stocks will be cyclical, which totally makes sense. They will do great when the economy booms because people require their services or their products, and they will of course slow down, and most of the time they have to invest massively. I mean, we're thinking about like transportation. In this case, we're talking about the trucking industry. So you have to still maintain your freight. If it's like railroads would have been the same thing. So if you cannot use them at capacity, well, of course, your margins are going to get squeezed, similar to construction products as well. So you can see that there's a common narrative, but completely different industries. So not exactly something that would say, oh, don't invest in the industrial sector. Or on the other side, could say, well, if all industrial stocks are down, it's time to jump in. It's not exactly how it went, but kind of like surprising that we're having like 3, 4 stocks now in this sector to talk about.
All right, so there's a Canadian company also trading in the US that was once like a darling among investors, which is TFI International. It is now down by about 40%. So what's going on, Mike?
Yeah, once again, numbers are going to drive the stock price. And it's something that is more common than we think. So here's what happened. When TFI International reported their quarter, the earnings per share was down about 35% on the top of my head. So on top of like that's already very bad. It was kind of like analysts expected, not a great year, not a great quarter, but not that bad, of course. And the worst part was management saying, well, that's going to be the guidance for the rest of the year. So for all 2025, we're going to see our earnings going down 35% and just get used to it. They had weaker margin due to lower transportation volume, exactly as I told you. I mean, they still have to maintain their freight. There's a lot of like capital invested. And if the trucks are not going through the United States and Canada to transport goods, well, of course, it's going to just cost money and not generate some. So earnings went down. And by telling the market, well, now you have to price TFI based on 30%, 35% earnings per share drop. Well, it's not surprising to see the stock price going down by slightly more than this because, of course, you have now the layers of like the recession coming and the tension between Canada and the US and all that stuff. But like when you go back to the numbers, it's literally saying, well, you have to rerun your calculators to determine a new value for TFI International because that great year we had last year, not going to repeat this in this time.
But is this like the type of stock worthy of our patience, or like would you buy more or just let go?
Well, for this one, I like the business model because TFI International is known to grow through acquisition and they make their best deal when trucking companies are struggling. So, right now, yes, they're not showing the best dividend triangle ever, but again, they're not losing money either. So, they are still in a pretty good position to keep up with their like classic playbook, wait for the slowdown that is actually happening right now in the trucking industry and transportation altogether, make acquisition, acquire new clients, try to bundle like and do cross-selling references. And when I look at the valuation right now, the forward PE ratio is at 17, so it doesn't seem to be that expensive. It's going to take a while to recover, of course, but I'm definitely not ready to give up the towel on this one. And full disclaimer, I do not have it in my portfolio, but I still really like it. The secret going forward will be to track those margins to see if the company is able to become more efficient while transportation volume stagnate for a while or slows down. Because after that, after an economic slowdown, well, the next thing coming up is another economic boom. So if they are able to go through this storm and become more efficient and leaner, which is usually the case that what happens with great companies, they're just going to come back even stronger than ever.
Okay, so another recent disaster is Apogee, which is down by over 45. Yeah, 45%. How would you explain this, Mike?
Run. Well, Apogee, there we're going into a different type of business in the sense that we're not talking about a small capitalization. When you invest in small cap, I cannot stress that enough. It comes with a great deal of volatility. It will go up, it will go down by wide margin. And then by wide margin, I think I'm talking about like those 45% drop. That
Mhm.
hurts. That hurts, but it's not, I don't want to say it's expected, but it's less surprising if I put it that way. Right now, dividend triangle is slowing down revenue and earnings per share. I mean, they're in the construction business. They're making structures and glasses for mostly buildings and stuff. So if there's a slowdown in construction, well, of course, they're going to get hit with that. But the latest quarter was bad. I mean, they had lower volume, weaker margin. You can see that there's like a common theme here. Same thing with TFI International. You sell less while your manufacturers are not at capacity, you're hurt, and now they miss both on revenue and earnings, and that clearly rattled investors. They, on top
Mhm.
of that, just to put the cherry on top, which is usually why the company will continue to slide even further, disappointing guidance. So now investors are thinking, okay, so you had a bad quarter. You're telling me that for the next 12 months, it's not going to look good. And now I'm thinking a little bit more, oh, potential recession, economy slowdown, the construction business not doing that great. Wow. Like you just gave me too many reasons to drop the ball in Apogee. And keep in mind, most of the time, the stock market thinks short term. And it's really hard for investors to think long term during that time. So
Mhm.
whatever happens right now doesn't mean that it will completely destroy Apogee, but it's just a reflection of what's going to happen in the next 12 months. Probably no good news. So now you have to suffer a little bit more.
Okay, now Apogee has a good rating at Dividend Stocks Rock, so does that mean it's a good time to buy it?
Well, again, if we like a stock, doesn't mean that you should like it either. Same thing for any type
Mhm.
of ratings. I mean, most of the time I'm in disagreement with Morningstar's rating. Doesn't mean that I'm always right, but doesn't mean that they're always right either, which is what's the best part of the stock market, right? You always need a buy side and a sell side. If not, we would not have any transaction. I really like the long term perspective, though. I like what Apogee's making. The overall over time, the dividend triangle is relatively strong. And I like it, especially at a forward PE ratio of 10. So yes, it's a small cap. Yes, it's like it's never gonna be like kind of like those like fundamental stocks or core holdings in your portfolio.
Mhm.
It's the spice that you add to your recipe to make it taste better. Sometimes you put too much spice and then you scrap the whole meal, but that's why you have to be careful, right? But I still like the long term on this one. Again, small cap in a cyclical environment, they rarely do well, but after that they could come back faster. So that's why I still like Apogee. But full disclaimer, don't have this one in my portfolio either.
Okay, now I know pretty much nothing about the next one, and I believe it's the first time that we will talk about it. So, Robert Half, RHI, is down by more than 40%. What is it about? First, because I don't know it, and what could explain this fall?
Yeah, I mean it's kind of fun to pull out some like under the radar names from time to time. So Robert Half is specialized in providing talents. So we're talking about a kind of like an HR business providing like talents in finance, accounting, technology, marketing. So a lot of like in high demand type of jobs. And the search for talent is like super important for those companies. I mean, an accounting firm is pretty much nothing without its accountant, right? I mean, like good
Right.
accountant will attract good clients and so on. Same thing in the financial industry, same thing with technology and so on. So what happens though is because you may be thinking, well, companies need talents all the time. And yes, it will be cyclical, of course, because it's going to follow the economy. But for those better jobs, it should be a little bit more resilient, even in a downturn. So you expect that it would go down, but not that bad. And this is what's
Mhm.
happening with Robert Half. The dividend triangle is getting completely destroyed, meaning that revenue and earnings per share, they're going down like a I don't know, like a ski slope for like those like triple jumps that you do in the Olympics. It looks like that, just like all downhill, like not good. And I thought it was interesting to pull that one because Robert Half was a part of those companies that saw their stock price skyrocketed after COVID because, of course, the search for talent back then became completely crazy. So super strong revenue growth, super strong earnings per share growth. And then, of course, the price skyrocketed. And now everything is going back down. But the earnings per share are getting hammered. And of course, we have weak demand on top of that right now. Fear again of the recession that is just adding the nice like icing on the cake of something that like that recipe that actually you should have not put like hot pepper in your cake because it's not going to taste good. And the recipe is disaster at this point.
And again, buying opportunity or company that you would never buy.
So that's a tricky part. I'm not super interested in that kind of business model. I kind of understand the needs and stuff. It's kind of interesting, but I was like, yeah, not necessarily a stock that I would buy already. On the other side, though, the good news I would highlight is Robert Half does not have long term debt. So, yes, they're suffering right now, but they have no debt. I mean, they have like a very solid balance sheet. They can test investors' patience, but there is like a way out here because they have a very strong balance sheet. They need to stop the bleeding. They need to start showing some stability at first because of course you're not going to like come from like double digit drop for all your metrics to double digit up, but at least you need to slow down, start to have something like hit a plateau, and then start talking about growth again. So I would consider it more like a speculative play at this point. But the fact that it has a strong balance sheet and it offers like an interesting service where I think they will continue to have like high demand in those fields moving forward. I would be patient with this one and see like what's the other side. A big part of that drop, that 5% drop also comes from the fact that the stock price probably went too high too fast. So if you put everything into perspective, and this is sometimes like, and it goes both ways. Sometimes people are just like, hey, Mike, look at this stock. It's up like 50%. And I'm like, yeah, it's up 50% after it lost like 80% of its value. So it's not really
Mhm.
up 50%. It's trying to recover, and it doesn't make a huge deal out of this because once you drop by 80%, you have a long way to recover, and being up 50 is, yes, it's a first step, but it's the first step to like go up to Kilimanjaro. Like you're going to need a few more steps to get on top of that.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. Okay, so let's end the episode with Adentra down by around 24% since the beginning of 2025. Why is it difficult for them?
They are in the construction product business, so they distribute architectural, that was tough, building products. Like think about like mostly like everything related to wood and plywood and stuff like that. So mostly for residential and commercial construction. Of course, when you're thinking about construction products, super cyclical, recession expected as well. But then again, we're coming back again on the numbers. Latest quarter, revenue up 1%, but the earnings per share went from 76 cents last year to 42 this one. Definitely not good news for investors. And once again, that's going to drive the stock price. It's another case also of the what I would call now the COVID hangover. With all that renovation, we saw like a big spike in demand, so making ton of money, and then boom, tariff war concern, everything is like on and we have like higher interest rates in the US that has not dropped that much. It's still a bit better in Canada, but still we feel that renovation has been kind of like pretty much done over the past few years. So now it slows down. Management said that there's no applicable tariffs on their business model because they make sure that they have like manufacturers in Canada and in the US. So they mentioned 90% of their business will not be affected by any kind of tariff if it ever happens, because I mean, we're still circling in circles here. But again, bad numbers will drive the biggest narrative here. So Adentra is taking a big hit. It's not a big cap also, so it's relatively small cap here, so prone to more volatility.
Is that a company that you would consider buying, or is it just time to wave it goodbye?
Probably an interesting speculative play. As you can see here, when you have like those smaller caps or speculative plays, what's important here is to ask yourself, is this the kind of business I want in my portfolio? So if you kind of
Mhm.
like did not think about that too much and just got seduced by the great investment thesis or the great numbers that we had right after COVID, and you bought companies like Robert Half or Adentra, maybe you're thinking, oh, that's not the kind of stock I want to own in my portfolio. I'm not comfortable with that kind of craziness. And then it would be the time to kiss it goodbye. Not because of the price and because the money that you lost, but more about the fact that, well, it's not a good fit for you. It's not a good fit for your portfolio. And it's just to realize that there are plenty of different types of businesses. That comes with like pros and cons, of course. And
Mhm.
then when you discover, oh, this is the type of flaw or potential risk I don't want to have in my portfolio, well, then that's the sign that you should sell and move on and build a stronger portfolio based on stronger conviction instead of keeping those stocks in the hope it will recover. Because as I like to say, hope is not an investment strategy.
Okay, so to summarize this, I would like you to offer like a quick framework to investors to help them analyze what's going on and decide what to do when one of their holdings is down by 20% or more.
Yeah, so I told you at the beginning of this show I would give you a framework. Today I wanted to provide you some examples, and now I'm going to give you that framework that I use every single time I have a stock that is down in my portfolio. The very first step number 1, is really to identify why the stock is down. And literally like over like high level, it's like 3 reasons. The first one, the entire stock market is down. So, and then don't tell yourself that because Trump is affecting the market. Look at the real numbers. So, look at the index. If you have a Canadian stock, look at the TSX 60. If you have a US stock, look at the S&P 500, or if it's a tech stock, it could be the Nasdaq. But look at an index and see what's the performance. If the S&P 500 is down 35% and your stock is down 25%, you actually kind of have a winner in your portfolio. So you don't have to worry too
Mhm.
much. Second level could be, it's a sector thing. As you highlighted in this show, industrial sector had like many losers in this episode. So maybe there's a problem with a sector. For example, when interest rates started to rise, REITs did not had it well. It was pretty tough. Utilities,
Mhm.
same thing. Why? Well, they're heavily leveraged, they're capital intensive, the debt load is important, the interest charge is important. So that's a sector thing. So you have the market, you have the sector. So those things probably should tell you to wait a little bit more, unless your company, the company that you have invested like is the worst performer of all. Well, that comes to this the third layer. It's probably a company problem. So as we
Right.
discussed today, like for Apple, for example, it's definitely not because of the market, because the market is up. Definitely not because the sector is down, because technology, a lot of technology stocks are up right now. So it's a company problem. So once you know where the problem comes from, then it's a lot easier to identify what's going on. So that's the first step. The second step is to look at the numbers. Before looking at the narrative, look at the numbers. I've given several examples today of companies that disappointed with their quarterly earnings, disappointed with their guidance. And when you look at the dividend triangle, you can see the trends. And then it's going to tell you a lot about what's going wrong with this business. Step number 3, now that you know where the problem comes from and you have looked at the numbers, you go back at your investment thesis. And we're going to have a next show, I think actually in July 9th, we're going to have a great podcast about how to craft the investment thesis. But the investment
Mhm.
thesis is all the reasons why you bought that stock in the first place, why you like that company in the first place. And then you verify thesis with the numbers and you determine, well, is this still valid? Was I wrong? Because it's possible that you were wrong. I've been wrong many times with my thesis, but whenever I'm wrong, because I look at the not the stock price, but the numbers, like the revenue, the earnings, the dividend, the payout ratios, all the other financial metrics. If they're telling me that my thesis is not good, well, then it's probably time to sell. If it's a temporary problem, such as what we have with Apple right now. Oh, we have a dividend triangle that is slowing down. The narrative is not that great. What do you do? Because that becomes a little bit more in a gray area than something
Mhm.
that goes down super fast. So what I do is I ask myself, how long am I willing to wait? So yes, waiting for you don't want to buy or sell on a 20% move on either up or down. That's just being trigger happy. You're gonna make a ton of transaction. You're gonna miss on a lot of recoveries. You're gonna sell winners way too soon. So instead, I'm just asking myself, okay, what's the number of years I'm willing to wait? Usually I try to pick 2 to 3 years. It's not that easy to turn things around for a large business, so you need a little bit more time. But when I'd establish, okay, so I still believe in Apple, I can wait 2 3 years with that, that's fine. But then what you need is to have a plan from management. I mean, management must acknowledge the problem first and then must say, okay, here's how we're going to grow going forward. So kind of providing you an extra investment thesis type of thing. And
Mhm.
then you monitor quarterly. You monitor quarterly for 2 things: how the plan is going, of course, and then do you see any improvement in the numbers? And by improvement, I'm not saying, oh, if the stock the next if in fall Apple doesn't show double digit growth, I'm selling. That's not what I'm talking about. But what I'm talking about is what they have done in the past 3 6 months, and now maybe, oh, okay, so last quarter the revenue were down 5%, and then this quarter, oh, they're flat. It's not great, but it's definitely better. So you
Mhm.
want to see improvement over time. And if after 2 years nothing happened, like the dividend triangle still stagnate or slows down quarter after quarter, management isn't doesn't find any ways to fuel some growth into the business, well, then it's probably time to sell. But you should never buy or sell based on the stock price performance. It's not because, and I'm gonna circle back that to my team, that right now, yes, we have 10 losses, but it doesn't matter. What matters is your next game and how you actually do. You improve? Do you make modification, or are you just repeating the same mistake over and over and over again? And if you're
Mhm.
just repeating the mistakes, well, then it's the time to sell your stock. But if there's improvement, if there's a plan, if there's progression, then you can believe that this stock is on the path to recovery. And that's why I will never say, oh, that's a good investment or that's a bad investment on short-term returns. That would be, I mean, and most of it sometimes is just pure luck. So you would say, oh, Robert Half was an amazing stock. Well, that was in 2021. And then fast forward 3 years, oh, it's a terrible one. Well, probably that the truth was not, it was not an amazing stock and it's not a terrible one. And the truth is fine somewhere in the middle.
Well, thank you, Mike, for your thoughts on these troubled stocks. Listeners, if you're still hesitant to build your dividend growth portfolio, be sure to download the DSR Investment Roadmap. It will give you easy steps to do it like a pro. Enter your name and email at thedividendguyblog.com/roadmap. For our show notes and related content, visit thedividendguyblog.com/235. If you like what we do, thank us by hitting the subscribe button underneath our podcast logo and leave us a 5-star rating. Until next week, stay invested.
Stay invested. Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.